For years, digital payments operated in fragmented silos. Closed-loop digital wallets captured user deposits, but that liquidity remained trapped inside the specific corporate ecosystem. That architecture is being dismantled in favor of a harmonized, interoperable national grid, where fiat value flows freely across competing platforms. The blueprint for this overhaul is the Reserve Bank of India's master directions on prepaid payment instruments. Tech entities scale at the speed of software, accumulating millions of users and managing massive deposit pools without the traditional constraints of a bank charter. Left unchecked, this creates systemic financial risk. The RBI is forcibly upgrading this ecosystem, converting a landscape of isolated startups into a standardized, interconnected network. We can deconstruct this mandate by examining three core regulatory pillars: capital requirements, escrow firewalls, and customer liability. By bridging the gap between tech agility and central bank conservatism, the RBI forces non-banks to adopt institutional-grade accountability. This split screen illustrates the RBI's risk-tiering system for digital wallets, divided entirely by the depth of customer verification. On the left are small PPIs. These require only minimum user details, and their utility is strictly locked to purchasing goods and services. They carry tight financial caps, the total amount loaded in a single month, and the maximum outstanding balance at any time cannot exceed 10,000 rupees. You cannot transfer these funds to a peer, and you cannot withdraw them as cash. Furthermore, they operate on a strict 24-month countdown. If not upgraded within 2 years, the wallet is frozen to new incoming credits. To prevent this freeze, users must undergo VSIP, a video-based customer identification process, to fully verify their identity. Completing that process unlocks the right side of the framework, full KYC status. The balance limit jumps to 2 lakh rupees, and both peer-to-peer transfers and cash withdrawals are fully enabled. The RBI engineered the minimum detail wallet as a temporary on-ramp designed to funnel users towards fully verifiable financial identities. While consumers face strict transaction limits, the corporations building these networks face a formidable financial filter. As shown on this timeline, before a non-bank entity can submit an application for authorization, it must prove a minimum positive net worth of 5 crore rupees. By the end of its 3rd financial year, that entity is legally mandated to triple that requirement, maintaining a net worth of 15 crore rupees at all times. This liquidity is continuously verified through mandatory annual certifications by chartered accountants. This steep capital curve filters the market, ensuring only highly liquid, institutional players handle public fiat, effectively shutting out underfunded, high-risk startups. Behind the metrics on a smartphone screen, digital wallets represent actual fiat currency. Non-bank tech companies accumulate massive pools of this pre-funded consumer capital on their servers before it is actually spent. This diagram outlines the RBI's structural defense, the escrow firewall. The tech entity is isolated from the deposits, which are locked securely inside an escrow account at a scheduled commercial sponsor bank. Mathematically, at the end of every business day, the balance sitting in that escrow account can never be lower than the total value of all outstanding wallets, plus any payments owed to merchants. Customer deposits must clear into this account no later than the close of business on the exact day they are loaded. Once secured, the money is bound by a strict whitelist. Funds exit this account through highly specific pathways, primarily to reimburse merchants, pay taxes, or process customer refunds. The master direction explicitly prohibits the tech company from ever commingling this escrow liquidity with its own operational funds or other business lines. This escrow firewall is a structural failsafe. If a non-bank issuer goes bankrupt, deposits remain secured inside the sponsor bank, protecting merchants and consumers. Once an issuer clears the capital barrier and establishes its firewall, it is mandated to plug into the wider national grid. The regulations require that wallets become fully interoperable through the Unified Payments Interface, while physical and virtual cards must affiliate with authorized card networks. Opening these closed loops to external networks mathematically increases the surface area for cyber attacks and third-party data breaches. To address this exposure, the RBI established this customer liability matrix. If a fraudulent transaction results from issuer negligence or a security deficiency, the customer's liability is absolute zero, regardless of when reported. That liability remains zero during third-party system breaches if the customer reports the unauthorized transaction within 3 days. If they take between 4 and 7 days, their maximum loss is hard-capped at 10,000 rupees. Only if the report is filed after 7 days does the liability fall under the discretion of the issuer's own board-approved policy. Crucially, the legal burden of proof rests entirely on the issuer. The company must actively prove the customer was negligent to avoid paying out. When a transaction is disputed, the issuer must execute a notional reversal, crediting the funds back to the user within 10 days of notification, before the internal investigation is even finished. By forcing issuers to absorb the immediate liquidity hit of cyber incidents, the RBI ensures companies deploy proactive, institutional-grade fraud prevention systems or reactive support. Zooming out to the macroeconomic level, this heavy compliance burden functions as an intentional and highly effective market filter. The master direction enforces this with a strict cooling period clause. If a tech entity's application is rejected by the RBI or their authorization is revoked, they are legally banned from reapplying for 1 full year. This single rule preserves central bank regulatory bandwidth by actively deterring unserious or experimental players from attempting to launch. Demanding bank-level capital reserves, hard-coding escrow firewalls, and mandating zero-liability interoperability sets an unforgiving baseline for operations. The RBI classifies these non-bank digital wallets as critical national infrastructure, moving them beyond the regulatory scope of simple consumer applications. The central bank constructed a high-friction barrier to entry, precisely to guarantee a high-velocity, high-trust playing field for the entities capable